Good evening, everyone. Welcome to Juwai IQI Canada Evening Talks. My name is Yousaf Iqbal, country head with Juwai IQI Canada. And in this episode, we have none other than our chief economist, Shan Saeed from Juwai IQI. Good morning, Shan. How are you doing?
Good morning, Yusuf. Greetings from Kuala Lumpur. I am fantastic. Good to see you again.
Good to see you again. You know what I'm missing from this episode to what we did last time was really amazing because I was sitting at the head office, on level 10 with Shan Saeed and doing a live over from there on there. So that was really an amazing experience. Thank you so much for that.
It is my pleasure.
Shan, I just wanted to, thank you as well. You're an amazing host for the people to know that when, we were there, it was an amazing event which we had. We talked about it last time as well. And Shan Saeed personally is a very, very amazing host as well. So thank you so much for that, Shan.
Yes, Yusuf, it's very nostalgic now that 2nd and 3rd March we were having this event, and now we are ending April. So
Yes.
time is like running like it's like running like a bullet train. It's going so fast. It was a good
That's
event to
true.
interact with people from so many countries,
Yeah.
and you understand them and you understand their perspective. So it's a good learning experience in the convention. Plus the networking it provides that in one go you can meet so many people. Obviously, you cannot
True.
meet 7,000 people in 2 days, but at least you can come across people and you can, share what is happening and learn from them what is happening in their area and in their country. So it's good to meet many people in the convention.
Absolutely. Thank you so much for that, Sean. So let's start with our program, and then I'm going to right away start some questions.
Please.
I'm going to start with bond market. Bond market has been in a turmoil. The latest update from J.P. Morgan favors risk premium for favors short-term fixed income. I know that you follow the debt market very closely, and you get a lot to forward your guidance on a lot of asset classes as well. What's your analysis now in this current financial market landscape?
Yes, thank you for sharing this. Yes, Yusuf, I read this report from JP Morgan. This is the latest one. It appeared yesterday. Clearly, it indicates that the markets are looking for short term fixed income bonds. Nobody is interested in 5 years and 10 years. That's why the short term rates have shot up to 5%, and it indicates that investors they want yields in the short run. So the short run is 3 months, 6 months, 1 year. That is a short and long term. But if you were to ask me, are you interested to commit your funds for 5 years? I think the markets are so bad, especially the bond market and the equity markets, that nobody is willing to commit for long term like 5 years. So we have
Yeah,
been sharing in this global talk that bond is the worst asset class to be in because inflation is high and the yields are not as high as inflation. So obviously you're not making money in the debt market. So when you are looking at all the asset classes, perhaps debt market is the one that we follow quite religiously, and it provides forward guidance, as you said, for many asset classes, whether it's commodities, whether it's equities, whether it's real estate. So right now, short term, yes, investors are looking at short term. Nobody's interested in long term. So in the short run, the yields will continue to go up, and that's what we are witnessing in the market right now. But as I said, equity and bonds market will stay under pressure. 3rd May is coming. Fed will increase 25 to 50 basis point. But again, after that, they will hit the pause button, just like Bank of Canada has maintained status quo in its last monetary meeting. So I think the central banks from US, Japan, UK, European Central Bank, and of course Canada, they will not increase interest rate. They will hit the pause button and then they will cut interest rate, let's say 100, 200, 300 basis point, depending on the situation of the economy. What with the landscape in the economic area, they will cut according to the situation. So I think rate cuts are coming very soon, maybe after 3 4 months. As I said, October November is the target. So, or it might happen much earlier than that, maybe in August, September, depending on the market, the economic landscape of the country. So, I think overall we expect that central banks will cut interest rate, and this is a good news for especially for real estate investors, because the rate will go down and investors can re-enter the market and they can book their mortgage rate at a much lower price. So overall, I think bond market will stay under a lot of chaos. And right now, policymakers have two things to address. One is how to tame inflation, and the second, how to bring down the market chaos. Market chaos is getting too much, and it's not easy for every investors to understand and to take the pressure of equity and bond markets. So bond market right now, they're not in a good place. But when deflation is there, that's where the bond market will appear to be one of the favorite asset class for many investors.
Amazing. So I know we talk about the interest rate. That's also one of my questions a little later on the agenda when I'll talk about that as well. But interestingly, what you said, that there might be another increase which will come from the Feds, and then eventually we'll see the interest rates going up, going down, point on that. And I guess it's always the asset class where people is supposed to be investing, or where people have been investing. What Shan has been saying to me, at least from since 2015, is something you can get your hands on, Yusuf, which is going to be a land, a property, gold and silver. So I guess that asset class will always remain ahead of the rest of the asset classes.
Absolutely, absolutely.
Great. My second question to you, Chat GPT. It's become a word right now. It's a new buzzword in town. Elon Musk is also jumping into Chat GPT in industry. The increasing popularity of Chat GPT has proven that ongoing innovations and conversations, AI is, artificial intelligence are materializing in a faster than anticipated pace, right? The industry expected mainstream adoption within 3 to 6 years, but yet ChatGPT is here and now. ChatGPT revenues are expected to hit like 4.3 billion by 2027. I really would like to know your global perspective on that.
Yes, Yusuf, Chat GPT has become the buzzword. So Chat GPT is in vogue, as we say. So it's very simple. If you want to stay relevant in the market, if you want to stay relevant with your investors, you have to adopt technology. If you don't adopt technology, you will go back to Stone Age. So the choice is yours, whether you want to stay relevant or you want to go back to Stone Age. So ChatGPT is one area that it will continue to boom. And as you mentioned, Elon Musk has jumped into the bandwagon, and he said, "I want to take advantage of this ChatGPT and I want to create my own ChatGPT." And Yusuf, you'll be surprised. I did not know about GPT. What is GPT? GPT is generative pre-trained transformer. That is Chat GPT. Generative pre-trained transformer. The information that you need, he already got that, and then he feeds you back, and then you get all the information what is happening in, let's say, in the global economy, what is the narrative that is being built up around the global economy. So Chat GPT will provide you all the information. So yes, ChatGPT will remain hot. We had a training session last week conducted by Dave Chong. It looks very interesting, and you have to adopt it in order to increase your productivity, in order to become more efficient, in order to get more ideas from others. So in English, they say two heads are better than one. So obviously, you need to seek guidance from this Chat GPT, and you can seek support, and you can leverage from Chat GPT. So I think Chat GPT will remain pretty hot, and people have started using it. There are already more than, I think, 500 million users, and they are going
Wow.
up with every passing uh, day. I wouldn't be surprised that if more and more users, maybe 1.5 or 2 billion users, would hit the market by year end. So that will create a huge noise. And for those companies like Elon Musk has is planning to enter in this chat GPT, the revenue stream looks pretty solid, and that's how many global players are looking at ChatGPT from the revenue perspective. So ChatGPT will have a very good future for the next 5 to 10 years. That's what I can foresee. And after that, I think we might be having another ChatGPT version, which would be better than the current one. So it will keep on going, and the competition will remain stiff for many players. But it's fun and it's quite interesting, and you have to learn from ChatGPT. I think, as I said, it will make you more productive, more efficient, and it will enhance and boost your productivity.
Totally agree with that. We have to, we cannot be left out on that, and that's what at Juwai IQI we call ourselves a prop tech company, and with our super app of Atlas, every time I log into it, every second and third, there's a new version updated towards it on that. At the same time, we as a company are so much into adopting the new technology as well. I saw those pictures which was shared by Dave as well when he was talking about the chat GPT and things like that. I mean, that's really where Joy IQI comes into picture as well, because we adopt technology and we understand that how important it is to stay up on the market side. So we are live with Shan Saeed, our chief economist from Juwai IQI. If you have any questions, you have any comments, you have anything you want me to ask specifically to Shan, please feel free to put it into the chat box. You can leave us a comment, leave us a question, and we'll be more than happy to cover it up in our next episode of that. So, Shan, coming to my third question, and what I'd like to do is that let me just go ahead and even share this screen as well. The latest issue of the Economist magazine, USA economy is riding high and still very relevant for the global economy. I cite Economist magazine, America's dominance of the rich world is startling. Today, it accounts about 58% of the G7's GDP compared with 40% in 1990. Adjusted for purchasing power, only those in uber rich petro states and financial hubs enjoy a higher income per person. You and I have studied and lived in USA. What do you say about that?
Yes, it's the if you decode the picture, US continues to lead from the front, as you mentioned that 50 it consists of 57% of G7 countries. Number one, number two, globally, US contributes 23 to 24% to the overall GDP. So I think the percentage is very high. That's why US continues to be a very relevant market for many players. The reason is very simple. Number one, size matters. The consumer market is so dynamic, and the purchasing power is there, income levels are high. America has got deep capital markets. It is very easy to raise funds in US as compared to any other country. Number two, the dynamism of the economy. The economy is quite dynamic. People who were laid off from Alphabet, the company, or Google, they are now looking for other opportunities and they are getting absorbed in the market. So the labor market is very strong, and right now the labor market is so hot that every person is getting employed. So the unemployment rate is pretty low at 3.5%, despite people are saying that labor participation is pretty low. And some people have been complaining that US economy might be worse off for our children in the next 5 to 10 years. Given the anxiety of people, it obscures the stunning success of US economy in the last 33 years, starting from 1990. So US economy is quite robust, it's quite dynamic. It is the size of the economy, the population is quite relevant, taking into account the consumption patterns are very high. The consumption patterns are high because the income levels are rising, and US is still one of the top economies where the per capita income is still very high. So it all boils down to demographics. It all boils down to how dynamic is the economy, how efficient your labor market is, and most importantly, US has got laws. The policy stability is there that investors would be willing to relocate um, and park their funds in the US capital market. Despite the capital markets have had a bad run last year, but as I said, it's very easy to raise capital in US because the capital markets are very deep, they are very strong, the regulations are pretty friendly, investors friendly, and above all, the investors are willing to take position in the capital markets. So that is a good part of the US economy.
Perfect. So, I also want to share with something which came in today's Financial Times that government earnings are down by 18% due to lackluster of their performance in the area. You have been sharing with us quite some time now. What's the impact of the banks if the Fed lower the rates in the next 3 to 4 months? That's what that's what we were talking about in the starting. That if the rates goes down on that.
Yes, the banks are under pressure. We have seen five banks have collapsed in the last 50 days, starting from Silicon Valley Bank, Signature Bank, Silvergate, First Republic, Credit Suisse. The banks are under a lot of pressure because the higher interest rates are not very favorable for those banks. So banks will remain under pressure, but once the interest rates will come down, it will give some momentum to banks. All the banks will have lower earnings in the first quarter, and the results are coming out. Goldman is one. Citibank is having good results. As I said, the bond market desk is not doing favorable for many banks. So that's why they are laying off staff. Goldman is already talking about laying off 3,000 staff. Bank of America is also laying off staff. So these are two banks that I know of that are laying off staff. So the banks will remain under pressure. But as I said, the interest rate cuts are coming. And once the cuts are coming, that will give boost to banks, and they will continue to give more credit to consumers. And it's all about credit that runs the economy. So the banks, in the short run, they will remain under pressure, but in the long run, banks will come back into the landscape, and they will continue to make healthy profits in the next 2 to 3 years. But the markets are under a lot of pressure, and that is given. And a lot of investors, they understand the market situation, that what is happening and how to navigate through these uh, tempestuous time. It's not easy to be in the
Yeah.
market, but if you understand the debt market, the bond market, and you see where the direction is going, where the central banks are taking position with cuts in interest rate, you can manage yourself quite successfully, and you can also guide your investors in Canada as well.
True, very true. So we're live with Shan Saeed, our chief economist, and for all our sophisticated and smart investors, whenever we talk about real estate, the reason we are able to talk about real estate in all different countries is also because we have a chief economist who's just not looking at one side of the country, but he's looking at overall all the countries at the same time as well. And with that kind of valuable insights, I'm so I would really want people to know that if you have not following Shan Saeed, I think you're still out of the main media. Shan is on CNBC. He's on, everywhere you could think about it. All the medias. Do follow Shan on LinkedIn. Do follow him on Facebook. I do it, and I know exactly, by following Shan, what's the call he's taking. Of course, he never gives tabloid stories. That's his from day one. His thing is that, he's always away from the mainstream, what people are talking about. And I guess that is the reason we are able to see that very helpful insights which come from Shan Saeed on that. So Shan, my favorite question always, because I'm a real estate guy and always look at the interest rate because, today also in our Therapy Tuesday, we were talking about it, how the market is coming along and things like that. So I want to ask you this, that the Bank of Canada, recently had this status quo maintained at 4.5%. You shared while I was in KL that the rate cuts are coming soon into the market. Now, this is a good news for the real estate investors, right? Always want to know more your insights on this, on the interest rate. Where are we heading? Which direction are we heading in the interest rate? Do we see that maybe there will be another increase that will come along, because it's been already twice there has been no increase on Bank of Canada side.
Yes, Yusuf, this is good news for your sophisticated and smart investors who are taking position in Canadian real estate. The question is, the conundrum is that inflation is coming down. So
Yes.
once the inflation is coming down, it will give some room for central banks to maneuver. That inflation coming down is a good news that monetary policy is making an impact. And I have been sharing with you that once you raise interest rates, whether it's 25 basis point, 50 or 75 basis point, it takes good 12 to 15 months for that policy hike to make an impact on the economy. It doesn't happen overnight. That inflation, you hike interest rates by 50 basis point, and after 1 week or 2 weeks, the inflation will come down. No, the markets, the consumers, all the stakeholders, they understand that inflation comes down after 15 to 24 months. And this is exactly what is happening in Canada, in US, in Europe, in UK as well, although the UK inflation is still high, but still it's coming down. So inflation is coming down because of two questions are there: whether the hike in interest rate is causing inflation to come down, number one, or the second question is, has Fed or Bank of Canada or ECB, they have hit the terminal rate. The terminal rate is the target rate that all the central banks are looking at, that once we hit the terminal rate, that is good enough, and from terminal rate we have the position to lower the rate once the inflation is down. Yes, inflation went up, but inflation is coming down. So I think uh, 200 to 300 basis point will be cut, not so soon, but maybe after September, October, because economies can't take the pressure of higher interest rates, and central banks are aware of this situation. So once inflation comes down, which is because the oil prices are still in the range of 83 to 86, which is quite manageable. Taking into account if oil prices are at $100, then there's a different story. But oil prices are moving in the range of $83 per barrel and $86 per barrel. So it's still manageable. And Europe has weathered the storm of higher prices last year and this first quarter as well. So in my opinion, eventually Bank of Canada, Fed, European Central Bank, Bank of England, they will cut interest rates. So once they cut interest rates, that is a point where your investors have an ideal opportunity to take position in trophy investment areas, like you have been saying about Cambridge, uh, Markham,
Yeah.
Calgary,
Yeah.
uh, Mississauga, and there are so many areas where they are good, trophy investment opportunities, and they are good assets, and eventually the market will be booming. Right now, the market might be soft, but still, I saw in one of your posts, for one listing, there are 43 bidders. For one listing, there are
50. Went to
43
50. 50
50.
bidders.
50 bidders. So that
Yes.
clearly shows the market is very attractive despite all the mayhem, despite all the chaos in the bond and equity markets. We are same in the 1970 era, where those sophisticated and smart and savvy investors who understand economics and history, they will always take position in real estate, gold, silver, farmland, tangible assets. So it's all about tangible assets. So I would request you that when you post this, you put another hashtag of tangible assets along with real estate. because
Okay.
tangible assets that very few people are actually talking about. We have been talking about tangible assets since 2021 when nobody was talking about it. We were talking about stagflation since November 2020 in a newsletter. Nobody was talking about it.
That's true.
So we were perhaps the first one where we said that stagflation is coming, 1970 era is back, and you pick up any newspaper, you pick up any mainstream media. Now everybody's saying 1970 is back. Now we are back to 1974, 1979. Some people are talking about we are back to 1929, 1933. So if you look at financial history, you can draw a lot of analogies to the current environment. And if you thoroughly understand financial history, you can educate and you can train your investors how to manage this volatility. Because volatility, market chaos, markets are nervous, investors are nervous, and markets are into an uncertain zone. They don't know where the markets are heading to. So I think in order to navigate through these tempestuous time, tumultuous time, if you can ask your investors to understand 1970 era, where you have oil shocks, oil embargoes in 1973, 1974, 1979, 1980. So it is very easy to take position and to have peace of mind. And you can only have peace of mind when you take position in tangible assets like real estate, gold, silver, farmland, vineyards. So I think this is all I have to say. But overall, the markets are expecting the interest rates would go down and many central banks will cut interest rate. That will be a real boom for our industry, that is real estate.
So very interesting, Ishan. I want to share what you're saying right now about the inflation part of it. So today's news actually came in saying that in Canada's inflation rate cools to 4.3% in March. So they're already looking at, as what you were saying, it's been the lowest level since August 2021. What we're looking at right now on that. So absolutely right. The way the inflation is getting controlled, I think the interest rates will start looking down. What's really right now is happening, Sean, from the real estate perspective. Although the interest rate, the Bank of Canada is holding the interest rate, there is no increase on it. But I was looking at some of the lenders, and I'm seeing that they're offering a fixed mortgage of almost 4.5 to 4.75% for a 5-year term, and then we're looking at close to about like 5.5 to 6% on the variable rate on that scenario. And then right now, even the interest rate is just stable; it's not going down. Buyers are already in the market because they've been waiting for this, and that's the reason we're seeing these multiple offers coming along with that. Just to share a little experience, our own listing by one of our agents in Richmond Hill. He listed the property on a Thursday night. On Friday, he had showings booked up all the way. On Saturday, he had already got like 6 offers on the property. Something listed for 1.3 million, got sold for 1,628,000. So you can understand, and this is the highest sold on the street, by the way, right now on that. We conducted an open house for our neighbors and people, and people were so surprised that how many sellers are still looking in the market to sell. So all those people listening to us, contact Team IQI Canada because we know what the local market is doing. We know what the international market is doing, and of course, with all the valuable insight which we get from our chief economist, we are there to help you with that. So it's very interesting to see what a lot of people are thinking about the market, and then another interesting thing I want to share, Sean, is that the numbers. So I did a market update just about like 2 days ago with Anu, and I was just showing the number that in the month of January, February, and March, there has been a steady increase in average price of it. And when that in May when we get the April numbers come in, you will be surprised to see that how the price have already gone up because the comparison was from March of 2023 to March of 2022. The market started slowing down, but now when we look at the comparison from year to year, even from month to month, we are seeing that the prices are increasing. So I still feel the same way. What you're saying is that even the interest is going to go down. I think the market is going to get a little bit more hot. What we're seeing right now.
Yes, Yusuf, what you just mentioned, the policy lever is making an impact. That's why inflation has gone down to 4.3%. If policy levers are not working, inflation will continue to show its head. But since the Bank of Canada has taken prudent approach, they have made some sagacious calls. That's why inflation has come down, and it is the policy lever, the monetary policy is making impact, and eventually inflation will come down, and then we will see the cuts coming from the central bank, maybe 100 basis point, 200, 300, depending on the economic landscape. So overall, I think it's quite bullish. And you're saying 1.3 sold out at 1.6 million.
Yeah.
So clearly it shows that investors' interest is pretty strong, and investors are keen to take position in those trophy investment assets, which will give them dividends in the long run.
Absolutely. Thank you very much, Sean. As much as I would like to continue, I know you have other appointments as well, and then we want to keep something for the next episodes as well. Thank you so much, Sean. For giving us time. It's been really, really always a pleasure hearing from you. I always keep following you on LinkedIn and Facebook. That's what I like to ask my viewers to do it as well on that. And then if you really want to know what's happening around the world, and that will help you to understand when you should invest, where you should invest, what's happening in the bond market, what's happening with the asset class market, then follow Shan Saeed on that. Shan, anything else you want to say before we say bye to our audience?
Thank you, Yusuf, for having me. I think you should continue to educate your smart and sophisticated investors that real estate can give you peace of mind. Since bond and equity market will remain under pressure, there might be some attraction next year. But for this year, I think bond and equities will be under pressure. Real estate will continue to drive. Family offices, sovereign wealth funds, institutional investors are taking long-term position in real estate. So I think real estate has become the new global currency. That's what we shared in 2014, 2015, and it's still very relevant. So you should share with your investors that real estate has become the new global currency. And if you want peace of mind, Yusuf Iqbal and his 200 people are available to take care of their financial needs.
Thank you very much, Sean. Everybody, please take care of yourself. Stay safe. Enjoy the summer is coming along, and take care. We'll talk to you guys soon. Thank you. Bye bye.
Thank you. Bye bye.